Have you ever been offered stock options as part of your compensation package, only to feel overwhelmed by the complexities of this mysterious benefit? Or perhaps you're an ambitious entrepreneur, determined to attract and retain top talent by offering a compelling equity-based incentive plan. Either way, decoding the intricate world of employee stock options is crucial for maximizing your earning potential or fostering a motivated, dedicated workforce. Are you ready to unlock the secrets? Whether you're an employee seeking to understand the true value of your stock options or an entrepreneur aiming to craft a compelling equity incentive plan, this video is your ultimate resource. We'll explore the nuances, the tax implications, and the strategies that can help you maximize the benefits of this powerful compensation tool. So buckle up and get ready to unlock the full potential of employee stock options. Your path to wealth creation and shared success awaits. Understanding the fundamentals. Before we delve into the intricacies of employee stock options, let's establish a solid foundation by understanding the key concepts and terminology. Shares versus options. Shares represent actual ownership in a company, while options grant you the right, but not the obligation to purchase shares at a predetermined price, known as the strike price or exercise price. The option's value. The true value of an option lies in the difference between the strike price and the current market value of the underlying shares. The larger the gap, the more lucrative the option becomes when exercised. With these fundamental concepts in mind, we can now explore the mechanics and strategies that can help you maximize the value of your employee stock options. The power of alignment. One of the primary reasons companies offer employee stock options is to align the interests of their workforce with those of the owners. By granting options, employers essentially enable their employees to become quasi-owners of the company. This alignment incentivizes employees to adopt an owner's mindset, encouraging them to think long-term and fostering a deep commitment to the company's success. After all, when employees have a stake in the game, they're more likely to go the extra mile, contributing their best efforts to drive the company's growth and profitability. The vesting schedule. Fostering loyalty. To further incentivize employee retention and loyalty, employee stock option plans often incorporate vesting schedules, also known as cliffs and vesting periods. The cliff refers to an initial period, typically 1 year, during which the employee doesn't receive any options. After this cliff period, the employee begins to vest in their options over a predetermined timeline, usually spanning 4 additional years. For example, an employee might receive 25% of their total option grant after the 1-year cliff, followed by an additional 25% each subsequent year until they're fully vested after 5 years of service. This gradual vesting process not only encourages employee loyalty, but also promotes a long-term mindset, aligning the employee's interests with the company's sustained growth and success. Timing is everything. While employee stock options can be a powerful wealth-building tool, their true value is often tied to timing. Companies typically offer these incentives after a first round of financing, but before embarking on a major hiring spree. This strategic timing allows companies to inject structure and thoughtfulness into their equity allocation process, ensuring that they don't inadvertently dilute their ownership more than intended by offering excessive equity to early employees. The decision of how much equity to allocate to an employee stock option plan is a delicate balance, influenced by factors such as the industry, the importance of key employees, and the company's growth stage. Typically, the first 10 employees can expect to receive around 10% of the company's equity, with subsequent hires receiving smaller allocations. Tax implications. Knowledge is power. Understanding the tax implications of employee stock options is crucial for maximizing their value and avoiding costly surprises down the line. In the case of Canadian-controlled private corporations, CCPCs, which constitute the majority of Canadian private companies, there are no immediate tax consequences for setting up an employee stock option plan or issuing options to employees. However, taxation occurs when the employee exercises their options, at which point they realize a taxable benefit equal to the difference between the strike price and the current market value of the underlying shares. Fortunately, the Canadian Tax Code offers a deferral mechanism, allowing employees to defer recognizing this gain until the point when they ultimately sell their shares in the company. Navigating potential scenarios. As an employee or entrepreneur, It's essential to understand the potential scenarios that can impact the value and treatment of your employee stock options. Company acquisition. In the event of a company acquisition, employee stock options typically vest immediately, accelerating the vesting schedule and allowing employees to exercise their options and capitalize on the transaction. Company failure. Conversely, if the company fails or stagnates, the employee stock options may become worthless, underscoring the inherent risk associated with equity-based compensation. Employee termination or resignation. If an employee holding unvested options is terminated or chooses to resign, they typically forfeit their ability to exercise those unvested options, emphasizing the importance of understanding the vesting schedule and its implications. Negotiation and optimization. While employee stock option plans are often presented as standard packages, savvy employees and entrepreneurs recognize the potential for negotiation and optimization. Employees, especially those in high-demand fields or with unique skill sets, may have the leverage to negotiate for a larger equity stake or more favorable vesting terms. Entrepreneurs, on the other hand, must carefully navigate the delicate balance between incentivizing key talent and preserving sufficient equity for future growth and financing rounds. Consulting with legal advisors and professionals who have extensive experience in crafting and negotiating employee stock option plans can prove invaluable in maximizing the value of these compensation tools. The psychological impact. Beyond the financial implications, employee stock options can have a profound psychological impact on both employees and employers. By offering a tangible stake in the company's success, these incentives tap into the innate human desire for ownership and a sense of belonging. For employees, holding stock options cultivates a heightened level of investment, both emotional and financial, in their work. They become more than just cogs in a machine. They transform into active participants in the company's growth narrative. This sense of ownership breeds a deeper commitment, a willingness to go above and beyond, and a vested interest in the organization's long-term prosperity. From the employer's perspective, this psychological impact can be a potent tool for fostering the culture of innovation, collaboration, and collective motivation. When employees feel truly invested in the company's future, they are more likely to embrace an entrepreneurial mindset, proactively seeking opportunities for improvement and contributing their best ideas to drive growth. The art of communication. Effective communication is pivotal in ensuring that the true value of employee stock options is understood and appreciated by all stakeholders. Companies that excel in this area not only attract top talent, but also cultivate a workforce that is fully engaged and motivated by the equity-based incentives on offer. Clear and transparent communication surrounding the mechanics of the stock option plan, the vesting schedules, and the potential scenarios are crucial. By demystifying the complexities and painting a vivid picture of the potential rewards, companies can inspire their employees to embrace the long-term vision and actively contribute to its realization. Conversely, a lack of transparency or ambiguity in communicating these incentives can breed skepticism and disillusionment, undercutting the very purpose of offering stock options in the first place. In the ever-evolving landscape of employee compensation, stock options have emerged as a powerful tool for attracting, retaining, and incentivizing top talent. By decoding the intricacies of these equity-based incentives, you'll be better equipped to navigate the complexities and maximize their value. Whether you're an employee seeking to build wealth or an entrepreneur striving to cultivate a motivated, dedicated workforce, remember, knowledge is power, and understanding the mechanics, tax implications, and potential scenarios surrounding employee stock options can empower you to make informed decisions that align with your financial goals and aspirations. Like, share, and subscribe to our channel for more valuable insights into the world of employee compensation, personal finance, and wealth-building strategies. Together, we can unlock the full potential of these powerful tools and pave the way for shared success.